Here's a video, and I promise not to babble on. It's a video about consolidating two companies, okay? And this, again, if you get the Google Drive, you go to Chapter 3. In Chapter 3, you go to M&A exercises, M&A Consolidation exercise, and Exercise 1 Consolidation exercise. Now, here's what the way this thing works is this. I've got a completed version here, okay? And what we do is we start with one company in blue. This is the acquiring company. And this acquiring company has some cash flow and it has some earnings per share, okay? And that earnings per share that this company has, we would like to see if we buy this red company with this many shares, will we be able to get an accretion or dilution in our earnings per share. Now, to do this sort of analysis, it sounds all very complicated and very, very sophisticated. And if you have the two models, it's all you have to do is really understand kind of a little bit on a share purchase and a share exchange. And there's our graph that's going to show with and without the merger. I just deleted everything. This is one of these ancient exercises, and I'm hoping that I don't have to add new lines and everything else, so we can still use the original exercise. So let's see what we started with. We started with, well, here's the current share price of the target. Here are the shares of the target. I have a little fine thing that goes to the shares. Somehow I should, where are the shares of the target? There they are, somewhere here. Okay, oh, and then it's supposed to say go back. I guess you do this with hyperlinks. I haven't used that in a long time. And then we said we were just going to start with a premium. And here's the idea. There's no DCF analysis. There's no terminal growth rates. Nothing like that. It's pure what really happens. And if we have two companies in the same industry, what's going to happen with our earnings per share with and without this? So we could retire debt. That often happens because you violate some covenants. We're going to issue some new debt at 7% for 15 years. And our stock price, the acquiring stock price, is 15. The transaction cost, that's the fees and all that, are 12 million or whatever. We should have really put the units in here. And then we have some accounting assumptions about a write-up and some intangibles. And we should put some tax treatments in, and we're going to assume it's a tax-free exchange. Goodwill amortization, let's put it false. I don't know why. We always, of course, have a impairment study for goodwill. And then these are the financial assumptions for a combined company. Okay, we have to put some interest rates and some other stuff in here. Okay, so that's our starting point, and let's just work through this. So I guess we could put an implied PE ratio. We from the price to the earnings, from the two models. The red one shows it's the red one, the blue one. So we have a higher PE ratio than them. We can play the kind of PE game, and we'll show you later. Excuse me. The shares outstanding are here. So our market capitalization, I hope, is our share price times the number of shares. Okay, that's kind of the way to start some of this. Our enterprise value. Let's do this. I hate to do this because we better have there's a whole page that talks about all the bridge between the enterprise value and EBITDA, and equity value rather, and then we have EV to EBITDA for the two companies. And if we want the price to the equity, we can take the capitalization and divide it by the book value. And that's useful for a lot of other things. The consideration we're paying is just the amount of the market capitalization for the target company times 1 plus the premium we input. Okay. So I suppose I probably did it here. That we could model this as an exchange transaction, a share exchange, or a regular transaction. If it's an exchange transaction, then we say, well, let's take the market price of the acquiring company divided by the market price of that. That means that they, if they had something worth 25 and we're going to give them something worth 15, they better get 1.67 of the stuff that's worth 15, and then we can multiply that by 1 plus the premium to give them the extra kind of kick on it. So that's the exchange ratio, and then the shares that we issue are in the transaction are the shares that they had, their shares outstanding, multiplied by the exchange ratio. They get a 2-to-1 exchange ratio. So now let's put our equity consideration, how much we're paying for the company. Okay, we put that here. We put in our transaction cost. Okay, and then we can put in, now we can see, well, how much debt was retired in the transaction. It's this times this plus this times this. Okay, so, the sum product command doesn't work perfectly with true false. What you have to do is, if you want to put a sum product, you need to shade the area and then put a multiplication instead of a comma. And there's no real documentation for this, and for other things that screws things up. So, but using that sum product actually with the true false and multiplication can be a kind of good thing to do. Then we have the amount of debt we issue for the transaction, and the remainder is the amount we issue, the amount of equity we issue. So that's our total sources of funds. And then I don't know why I put that share exchange stuff in there. That was crap, because we can say, well, here's our stock price, not theirs. Where's our stock price? If we've got to issue this much equity and our stock price is this, the shares we issue either through a share exchange or through oh God. I think that was okay. The share exchange is, the reason this is different from this is got a much smaller number. And then we go to the acquired shares. Where are the acquired shares? Okay, and we say, well, the total shares after we're all finished, and that's for our new company, increased to 122. Now, here is one of the crucial things. If you put the sources and uses and goodwill together, you can then very quickly get a pro forma balance sheet that has both the acquiring and acquire or transaction. We're going to have another exercise that only works on a pro forma balance sheet, and then we're going to take away some of the debt issues that were existing, and oh, I guess we'll put a switch here, and if it's false, if it's true, we'll leave it there. If it's false, we'll take it away. Then we'll put the new debt issue here. Oh, then we'll put their debt issues here. I hope we can find those. And then we put the new debt issue for the transaction, and then we add it all together. Then we put some accounting for our write-ups and our other things in, and then we can work through a profit and loss statement, and then put our balance sheet together. Really, these accounts could have been above and not below in the balance sheet. And then we'll be finished. So that just gives you a guideline of kind of where we're going. And, oh God, I don't feel like doing this. The equity consideration. So if we make the goodwill, you start with the equity consideration. You take away the book value of the target company. And I think we had that. Where did we have that? Target company goodwill, right? Book value, I know we had it here. Okay, and that gives you, if there was no other adjustments, then we would have, that would be our goodwill. Compare the amount we're paying for the whole equity of the company. But then we need to adjust for the write-ups. So if we have some asset write-ups, that pushes up the asset side of the balance sheet. And if you put up the asset side of the balance sheet, that means there'll be less goodwill. And that's the same thing for intangibles. We're pushing up the asset side, we've got less of a hole to fill. And then if there's a deferred tax liability, that has the same thing. We've got a lower liability. Dude, I did not put the deferred tax thing in yet. So let's just take the net after the write-up. Is this net minus this, minus this, minus this if we had something. And then I put why did I put the transaction cost in here? I added the transaction cost now. Oof. That's, from the time I made the model to this, that has a change. That is not going to be added to goodwill anymore. That's not going to be added to goodwill anymore. Then what we can do, we can just start putting these things in. So our plant got a write-up of 150. What else? Our intangible got a write-up of 100. Okay, and our goodwill ended up to be 660. Okay, and we could do a subtotal here, but let's do a subtotal for all the adjustments. And then when we go to our debt, our long-term debt, we put a minus sign on the amount in the sources and uses for the debt retired. And then we can put an equal sign and go to the debt issued. Where was that? So yeah, I hope you see a key thing. Everything here on this thing comes from the balance sheet. Now, what we also had is the equity account. The equity account, I'm going to put the amount that we reduce it by, and that's the book value of the company. Everything is coming from that. The amount we increase it by is the amount of the equity we actually put on the balance sheet. Okay, so there's a little bit of assumptions. And now, here's this pain. We have to subtract any fees. We have to write up the fees. That's the big change in accounting. In the old days, you could just put the fees into the goodwill account. Okay, Control D, alternate equal. That's our total adjustments, and then we put up here. This is oops. sum of this. Okay, Control D. Nine, 10, it worked. Never really works the first time. And then we can take our consolidated company as our target plus this, plus all of this. Okay, and 2350, 2350. Everything seems to have worked okay. Property, plant, and equipment went up by this much. Accumulated depreciation, nothing happened to. So that's our first part. Now, when we do this, I suppose I must have put a switch in here. And, you know, maybe the best thing to do on these debt issues is the following. Okay, and I think I'm going to just do this and fill it in and come back to you. Okay, I'm back. Oh, that was such a horrible kind of thing to do. We put in our little true and false switch, so if I retire this, it goes away. If I don't, it doesn't. So we can pay to get rid of the debt, see if it's callable or not callable, or if you have to pay a premium to get rid of it, all of that. All right, but now let's put in our new debt, which we just get from our sources and uses of funds statement. Can I find that? While I was doing that, I was just thinking, really, this retired debt should correspond to the detail below. Our new debt issued is this. Then we put a opening balance. And what was our tenor? We had a tenor of 15 years for some reason. So we'll make this a serial bond where we take the total and divide it by the amount, and then we can make our closing balance. What was our interest rate? Interest rate was, come on, what's the interest rate on our new debt? There it was. Okay, and so our interest expense is our opening balance multiplied by, well, we could make it the average balance. Okay, multiplied by the amount. Okay, and whoops, this goes below here. Excuse me. Okay, I suppose I wanted you to put in interest rate in a separate column. Interest rate. So now we add up all of our repayments. We're not paying, but not that much at least. So we get this number plus the second one plus the third one plus the fourth one. Okay, it looked like I have a little thing, and then we can add up our total repayments, total closing balance. Is that what the next one asked me to do? And why did it not ask about adding the interest expense? Okay, there's our closing balance. Oh, interest I put for some reason on the line below. Okay, we said, oh, I know, because if I put it on the line below, I think I could have just copied them without doing this. Okay. I hope I didn't make some mistakes there. Shift Control right arrow, Control R, and I guess this one, if we put here, we should see, well, let's look at our total debt on our balance sheet, 1380. Okay, I had to put a not in front of the true or false to did it backwards, excuse me, but it turns out that check was actually kind of useful, because what we did is we went up to the pro forma balance sheet and made sure all of our debt issues match the individual issues we have. Now we can do a similar, not exactly the same thing, but kind of a similar thing with the adjustments for the accounting, because we have in the goodwill, we have an asset write-up. Okay, and I think we input some sort of depreciation. Well, we put a lifetime here, so let's make this 1 divided by the life, and then we get some additional depreciation. Now we have to be very, very careful with this one. This is depreciation for book purposes and not for tax purposes. If it's a shift control R rather equals this one. Okay, and if it's the transaction is not taxable, that would result in a deferred tax, and there's a whole subject on this deferred tax business, which can get very, very can get a little bit confusing. How about I'll say that? Okay, so some of you really good accountants might say, that's so easy. Okay, and let's just copy this one across and do exactly the same thing. Take this one divided by the rate. Okay, and goes to the 4. Okay, and we have an additional deduction for the intangible. You notice that if we made it goodwill, there was no reduction on the accounting statement. Now we have to do a little bit of tedious things. Let's go down and find the EBITDA in the red. If this is going to be a pain, I'm going to stop it. And let's go down and find the EBITDA in the blue. Okay, this illustrates that we just really need to take our two kind of models that we did all of our detailed forecasts, and that's really where the key things are. And I didn't put any synergies in here, or did I? That accounting assumptions. Where are some synergies? Oh yeah, we put some synergies in here. Okay, and then alternate equal. Alright, and then we can do the same thing. Let's go down to the depreciation for the, I think it was for the target. And then, is that right? And then depreciation for us. And just a little above here, and then we have our depreciation adjustment, which we just computed, and we have our amortization adjustment. Of course you could set this, and I'm not proud at all of the way this was set up, so then we can get the EBIT is the difference. Okay, and you can see that the kind of operations, the free cash flow items, should have come from the individual company analysis, and some of this include, and then we have to add the synergies. That should have come, but when we get down to the interest, that's a little bit tricky. The interest, we could first put the interest that's on all of these debt issues that's already known. Okay, shift control right, arrow control R. But when we get to the fixed interest expense, well, we're going to have to do one of these adjustments where we say, okay, what's the cash less the debt, cash less the short-term debt. That's the cash we have on the balance sheet minus, let's not include all of the new issues because we've already accounted for that. This is almost like kind of a cash versus a revolver. And then what we'll do is take that versus the net cash flow, add them together. And if it's positive, we'll just call this cash. Whoops. Where did I put the 0? If it's a negative, now if I'm doing this too quickly, go and look at the cash flow plug in the corporate models, or there are a whole slew of these things. Now the interest rate on the debt, is that, shit. Well, okay, let's do it correctly then. Let's take and the cash balance in the very first year is just directly from our pro forma sheet. So hopefully, well, it probably didn't really work. We take that. It's supposed to show you that, it's a good idea to get that nice little pro forma sheet done. Okay. So there's our interest income, and then we can do the same thing, put the short-term debt we had over here, and remember this has got the whole corporate model circular reference problem here. So if you wanted to use the average balance instead of the opening balance, you'd have a circular reference. And you can make one of those fancy things to get rid of the circular reference, but at least when you're just starting to make the model, I would strongly suggest simply using the opening balance. So now we can fill in our short-term debt, and really that should have been, that was our interest expense on short-term debt. And just below there, I don't know why I made it that odd color. And then we have the interest income on our cash. And we can get our earnings before taxes, EBT, minus the interest, minus the other interest, plus the interest income. Not very exciting. And then we'll put our taxes paid. I suppose what I did is put this one, and I put some sort of tax rate assumption here, I assume. Okay, there might be some kind of tax synergies or something like that in the acquisition. And then finally, we have our earnings after taxes. There are a whole host of issues with taxes. The shares for the transaction, that was the key one. You put the total shares after the transaction right here. That's one of the key things. And then you can just take that, and that's the number you were looking for. That's the whole number to get our accretion and dilution analysis finished. Now we're not quite finished because we'll take our earnings. Oh, I hate what I just did here. Oh, add in the depreciation. So we take where's our depreciation? This one plus, horrible. This one plus this one. I think we should almost always start with the EBITDA rather than this. I didn't have a deferred tax change, and I don't think we put a working capital change. Oh yes, we did. We put one working capital change in for the acquiring company, the target company rather, and that we go down to the cash flow statement for them, and we put another one in for the acquiring company. Oh my God, is this boring? Okay, and then we didn't have any adjustments, so the total working capital change is this one, and our cash flow from operations would be the earnings plus the depreciation plus the amortization minus the total working capital change. And then we say, well, this is this idea that from a free cash flow perspective, from a true operational perspective, you just want to include the true capex, and so we put CapEx for the acquirer in next. And you know, there's a whole nother video we'll have on potential synergies from CapEx. Hopefully that'll be a little more interesting. Add that together, and then we get the, whoops, target, acquire, there was a synergy line, excuse me, put that here, screwed up the formatting. The debt repayments, remember we get the total of the debt repayments from this line, and then the dividends, I suppose we took the earnings after tax and multiplied them by some sort of payout ratio. Okay, and then we get our net cash flow, which is this is this was a subtotal, so let's take come on, we have our cash flow from operations. How could there not be an underline? Okay, I used to get in trouble for underlines. We have take away all the capital expenditures, so then we have another, and why this is bold, I don't know. That makes no sense, but foolish consistency is the hobgoblin of a petty mind. Perhaps that was my philosophy back then or something. And then we shade this, shift control right, arrow control R, and then we've finished our whole cash flow statement, and we finished this, and the only thing we have left to do is to make sure our balance sheet balances. Now, what I'm going to do, how's this? I'm going to start these closing balances from the pro forma balance sheets, and then the opening balance is the closing balance, and then we, somewhere in our cash flow statement, we had the totaling working capital change for both of these. So this would be Alt equals Shift Control right, arrow Control R. Now, do you really want to see the rest of this? I think, okay. Plant, property, and equipment. The balance comes from this number after the, and then we put this one in, and then we can say, well, let's go up and get our CapEx that we put in for our consolidated company. Alt equal, Shift Control, arrow Control, accumulated depreciation, the same thing, except I don't think we computed our accumulated depreciation going forward. So we take the negative of the accumulated depreciation, this was this, and why don't we put a minus on the total depreciation that we had. Okay. I can't, I was hoping you could leave it there. No, there's no good trick to doing this. Our intangible assets, we do the same thing. We not exactly the same thing on the intangible assets. We have our balance. Okay, and then we make our opening balance equal our closing balance, but this time we'll put a minus and get the, my dog's taking a little drink, good. And then we get the amortization. Okay. I shouldn't have done that. Alt equal. And then Shift Control. So what was that trick? I suppose I should have first made the Alt equal and then the copying. What was that? Let's go here. So we have goodwill, and the opening balance is equal to the closing balance, and unlike this, so let's try the same thing. I press alternate equal, Shift Control right, arrow Control R. Okay, that was a little better. Deferred taxes. We have the amount. Where is the accumulated deferred taxes? We didn't do anything with those. Just like with the goodwill. Okay. Alt equal. Shift Control right, arrow Control R. And finally, the common equity balance as the opening balance. Have equity and make the opening balance equal the closing balance. Go upstairs and collect the income. And that's just right here. Earnings after tax. Collect the dividends, and that's just from that was kind of the last line of our thing here. I suppose if we want to make it a negative, then we can select the whole thing. That was the trick, to make the alternate equal like that. And fine. And now we're just going to start putting our balance sheet together. So we begin by getting the cash balance. Then we get the working capital balance. Okay, and then we get the property, plant, and equipment balance. And the accumulated depreciation. And the intangible asset balance. And the goodwill balance. And then alternate equal. Okay, Shift Control right, arrow Control R, and then now let's do the debt balance. We can get the total long-term debt from that analysis we just did above. Oh no, what? Oh yeah, this is okay. Oof, scared. Okay, and then we can get our short-term debt balance from our little cash flow plug analysis, or whatever you want to call it. Deferred taxes and equity balance. And let's press alternate equal. Oops, it's good news we had to do first two, right? And then look at this. I'm going to have to stop the video. Oh, come on. Okay, I would like to say I made this mistake on purpose, but it took me a little while. It's a horrible thing. Just a horrible thing, but when you get it fixed, it's a beautiful thing. So, oh, look, there's the 72. Oh, let's see what we did in the repayments. Oh, you were shouting at your video. Add that one, you idiot. Add that one, you idiots. Okay, we'll copy this one down, and now our balance sheet checks. We can say this one minus this one equals 0, and Shift Control right, arrow Control R, and we're very happy. Okay, there we go, and that's consolidation of the balance sheet. Now, there are a number of issues we didn't talk really carefully about. It's exactly how the revolving credit would work, how the tax treatment works, how the I think that's okay. How the depreciation expense on the individual companies should really work. What you'd really do with the write-up of the assets and so on and so forth. But it does give you an idea, hopefully. It wasn't that difficult. And then you can kind of see, look at this ancient graph from something like Excel 97 or something, maybe earlier. This was our EPS with and without the merger, so This was our combined, standalone. Oh, this looks bad. Oh no. If we paid less of a premium. Okay, well, let's pay 0 premium. Uh-oh. The combined is better than the standard. If we paid 100% premium, then we're starting to get. Okay, so that's the kind of thing you can do. Let's pay 50% premium. It's still very beneficial, but let's say the debt issue is only 500. And then we don't have. So a lot of this came from the debt, all right, and then we can see what kind of synergies we need to break even. So we can at least use this one and see what happens. That's how you'd use all of this. Remember, there was no WACC, no terminal value, all of that. We could do all sorts of scenario analysis with this and everything else. So I'm saving this. Let me save this as a new kind of file. All right, and why you have to watch me saving this is ridiculous. Remember, financeenergyinstitute.com for very, very reasonable prices on, I hope, classes that will do a lot more than this. They'll touch on the valuation issues more than this.